Hello, I'm Geoff Dietrich. I'm a partner in a law firm, an attorney, and the creator of the Legal Foundation Blueprint, where we help purpose-driven entrepreneurs, direct sales representatives, and inventors figure out how to protect their products, themselves and their property from liability, and how to minimize how much they're going to pay in taxes. Today what I want to talk about is the S election. That's right, the S. We might as well call it the Superman election, because what it does is it saves your business from paying too much taxes. It leaves small buildings in single bounds, and it has the added benefit of seeing through walls. So, why do you want to be an S corporation or taxed as an S corporation, otherwise known as an electing subchapter S under the United States Internal Revenue Code? What a mouthful. Does anybody even know what that stuff means? You're going to file a bunch of forms, you're going to look at a bunch of things, and you're going to wonder, why on earth am I paying this much in tax? We can, with the subchapter S election, reduce how much taxes you're going to pay. And let me explain just in general terms how that happens. We talked about on a previous video that if you're a sole proprietor or a limited liability company, you're being taxed in a disregarded manner, meaning your business doesn't pay taxes. That's great. The downside is you're paying all the taxes as if you're you, the employee, and if you are the business owner. And I keep putting on these hats. These are my business owner hats. As you put on these different hats, you're going to have an additional tax burden. That's the downside of being an entrepreneur, is you get nailed on taxes. If anybody can solve that problem, I will vote for them as president. Call me up. Now, what happens with an S election, though? Under the subchapter S, you get treated as a partnership, even if there's only one of you. So as an electing subchapter S LLC, which is possible, or corporation, you get taxed as a partnership, meaning you wear two hats. So on the one side, you wear the employee hat, where you'll pay a salary out of your company to this great employee who happens to be you, and you are going to pay the taxes on that. Why would you want to do that? Well, because on the one hand, you get the benefit of paying some of your taxes in advance. Most entrepreneurs that I know that are in a standard LLC or are sole proprietors, they get hit every year, every April. They know I'm going to pay 7, 9, 12, 15. I even had a client that paid $60,000 in taxes in the prior. Why are we doing that? Let's pay some of it as the employee. You'll pay taxes out of your paycheck. Your company will pay taxes as the employer. So you're getting Uncle Sam his due. But then you step into a different shoe. And all of a sudden, you're treated as the brilliant investor who saw the vision of what you're doing and is being repaid because there's extra money left in the company after all the expenses are taken care of every month. Now when you're getting repaid on an investment, that's only at capital gains taxes. Capital gains are right now at 15%. So how would you like to, instead of paying 33% ordinary income taxes plus self-employment taxes on, let's call it $50,000, split that. And instead, you pay self-employment taxes and ordinary income taxes on half of that, or $25,000. The other half of your compensation, you pay capital gains taxes, which again is 15%. What are we doing? This is just smart maneuvers to lower the amount of taxes you pay, protecting you. This is building you a foundation whereon you have more money in your business, more money that you take home, less you pay in taxes. This is how you build a solid foundation to build your business on. Again, I'm Geoff Dietrich, creator of the Legal Foundation Blueprint. I'm a partner at Pearson, Butler, Carson & Cook. Thank you.